First of all, I just want to thank the Atlanta Society of Finance and Investment Professionals for giving me the opportunity to speak today, and I appreciate everybody coming out. One thing I hope to do, or hope we can do, is make this an interactive discussion. There'll be time to ask questions at the end, but to the extent something during the presentation prompts a question, please feel free to go ahead and ask. What we're going to talk about today is the state of the high yield market and where Brigade is finding opportunities. Let's see, the question out there right now is, are we there yet? Which is to say, we've had a powerful rally in 2016 and up until about a month ago in high yield. And so what you saw was starting in the second quarter of 2014, we saw high yield start to sell off. It actually it had negative returns for 5 of the 6 quarters from the second half of 14 into 15, which was really unprecedented. Obviously very much driven by oil and also somewhat driven by a decrease in liquidity that we saw in the high yield market. Into 2016, starting about February, about when oil bottomed as well, we saw a powerful rally that has taken high yield inside 6%. And so, that begs the question, is there still anything to do in high yield at this point and in the credit markets in general? And what I hope to discuss here is where we are seeing opportunities. I mean, the answer is, if you're looking to make double-digit returns and throw it into an index, there really isn't that opportunity anymore. Just the math doesn't work. However, if you're willing to kind of deviate a little bit outside the index and into a few areas we're going to discuss, we think there are still some pretty interesting total return opportunities. One thing that gives us a little bit of comfort is, despite this rally that we've seen in high yield, there's just not a lot of places to find yield out there. I mean, would you rather go into Portugal, which only 5 or 6 years ago, everyone was writing off as a default candidate, or even Italy and Spain, which now yield inside the U.S. 10-year. And again, in 2011, I remember people talking about the potential for defaults there. High yield still, and it's actually backed up now. We have had a sell-off in the last month, so it's back over 6%. There's just not much in the world where you can still get that yield. So that does give us some comfort that absent a real uptick in defaults, people are going to continue to, if you're seeking out yield, are going to continue to want to be in the high yield market. That being said, at 6%, 400 off treasuries, it's pretty hard, from an index point of view, to get a double-digit type return. And again, this chart right here just shows the dispersion of where bonds are currently yielding, and most things are 4.5%, 4 to 5%, 5 to 6% range. You can see there is still about a quarter of the market yielding over 6.5%, 7%. And that's the area I'm going to talk about and focus on in terms of where we're seeing some of the opportunities. One thing we like to look at when we're talking or thinking about whether there are still opportunities is this ratio right here. It shows the pickup you're getting between triple C spreads and double B spreads. And it's basically a measure of how much you're getting paid to take that extra risk to go to triple C's. And again, you can see at the moment you're still getting, you're picking up over 3 times spread being in triple C's versus double B's, versus where you go back. And if you go back historically beyond what I'm showing here, you would see that that's a relatively high ratio that you tend to see actually after big sell-offs. And so what it tells you is that the rally we've seen in high yield, a big bulk of it, has been in the quality. So what happened was people, when high yield came back, poured into all the index names, and that's what the flows you've seen have been very much index driven. And so what that means is all the good stuff, perceived good stuff, rips into 4 or 5%, and it leaves some of the smaller one-off names still lagging behind. And so, we do still see opportunities in what is perceived as some of the riskier names, even though we're, a year into this rally, because of the spread that you're getting. You're being paid for that. Similar sort of chart, just showing where the different yields are based on rating. And so what you can see again is within the CCC world, you're still getting 10% type yields or 10% or greater yields on over 40% of the names. So still plenty to do there. If you move into double B or even single Bs, most single Bs are yielding less than 6% right now. So again, for the credit quality degradation you get in going to CCCs, you're picking up an awful lot more yield. So we would still rather look for opportunities there until that ratio comes in. And I'm going to get to in a second, the signs of the apocalypse in high yield, and one of them is when that CCC ratio gets in, say, towards 2 to 2.5. That's one of the signs where you're no longer being paid, generally speaking, for the yields in the market, and that's generally a time to get out, to get out of the high yield market. So as I talked about earlier, here is 5, and there's actually a few more that I'll discuss. Signs that you tend to see when we're due for a major correction. This isn't to say that high yield isn't going to bounce. I mean, like I said, we're out 50 basis points this month. It could continue. A lot of that seems to still be oil driven again. We had our second biggest outflow from mutual funds last week. So the high yield market is going to bounce around, but this is focusing on, are we really at a market peak and are therefore due for a major correction like we saw, in 2014-15. That was the third biggest pullback we've seen. Obviously the biggest one was during the financial crisis, and the other major correction that's taken place was more prolonged. It was the 98 to 2002 period. I mean, that started with the Asian crisis. It then migrated to all the telecom blow-ups, the internet, and finished with the Adelphia and WorldCom accounting scandals. And so, what we're looking at right now is where are we in the market, and are we starting to see the signs that we saw before those prior sell-offs? So one thing you tend to see if right before a big sell-off is a prolonged period of spreads inside 400 basis points. So we did get inside 400 for a week or two back in February or late January, and then now bounce back up to over 400. Usually you're going to be inside 400 for a year or two. And again, it's not just that absolute level, like I talked about. It's also, look at the CCCs, that CCC ratio comes in, and what it means is people are so desperate for yield they're buying anything, and they're buying them at tighter and tighter yields to the quality. So at this point, we're kind of bouncing along until we stay in there. And in fact, prior to the sell-off we saw in 14. We were sub 400 for a good year. So we're still waiting to see if we get there. But that's typically been a sign. Another would be default rates being near historic lows. I'll show later, default rates are coming in, and certainly most of the defaults that we saw were tied to energy and mining names, but they're still at relatively over 3%, I think 2.8% now. Typically those are going to get towards 1%, but at a market top in high yield or before a big sell-off. Leverage ratios increasing. Generally speaking, high yield companies have been pretty good, and if anything, that's probably one of the areas that's been most impressive, in the sense that companies have really not started to massively lever up. You're not seeing big CapEx spending. You are starting to see some more dividend deals and things like that, but leverage ratios have hung in there. So not something that we are worried about. In terms of the low quality deals, that is starting to pick up. I think we had in the first quarter, we've had the most dividend deals that we've ever seen in a quarter, or in a first quarter of a year, I should say. So you're starting to see the low quality deals come back. So that's one that you may want to check. You're still not seeing the crazy leverage deals. I mean, in 2006, 2007, we had companies leveraging themselves, for what we thought the enterprise value was, putting in almost no equity value. You had the Caesars, the iHeart, the takeovers, Clear Channel, and those were done at 8-9 times type leverage and got done easily. So we're not seeing that. We're not seeing the LBO guys go, and I mean, they kind of learned that just because you can lever up a company 8 times doesn't mean you should. And they seem to be holding to that thus far, because that's the only way you can justify or get the returns when valuations are 10 times plus. And so what that means is we just haven't seen that much LBO activity actually. Given where we are, given if you looked at where spreads are, you would think you would see more, given that the markets are pretty accommodative right now. Last thing is deterioration of bondholder protections. This is something that, being a credit guy for the last 20 years, we're always fighting that battle, where the call protection weakens a little bit, or you have the ability to take out 10% of the bond at 103, but that's a good thing because you bought it at par. Well, it's not. I mean, call protection is one of the biggest things that you need to have as a bondholder to get the proper total return in the names that work, to make up for the fact that it's very asymmetric on the ones that don't work. I mean, you're at par. If you can't get 110 or 115 on the home runs, it's awfully hard to make up for that mistake you make that goes to 60. And that's been a big area that we've been pushing back on, is trying not to buy into into deals that don't have call protection. It's one reason why I really am not a big fan of the second lien leveraged loan market. I mean, we do a lot in leveraged loans, and in the first liens, I think are generally fine. But the problem with the second liens is it's the same risk you're taking in a bond, but they give you 102 call protection. They can take it out in a year. So it's if it works, you make 2 points. If it doesn't work, it could be down 50. And the other problem with those second liens is there's a technical, because so much get put into CLOs, that when bad things start happening, there is no buyer, because they're usually not juicy enough to bring in the hedge fund type total return guys, and therefore there's just an air pocket on those from par to about 80 until you see other people come in. One last thing I would mention that we've always seen, and I'm not sure it's necessarily something that you have to see, but you have seen every time that we've had a major sell-off has been a sector that you could point to that was the problem child. And again, back in 98-02, it was telecom, where you had massive build out of telecom networks that were duplicative and unnecessary, and those were not restructurings where you moved on. Those were zeros in a lot of cases. And obviously in 07 we had 06, 07, 08 we had housing and then banking system, and then what we saw back 14, 15 was the energy sector. I don't see that out there today in terms of a sector that I think could bring down the market. I will say retail is obviously the most likely candidate. It's still relatively, compared to energy is by far the largest sector in terms of weighting market value in high yield. So when that sold off, that makes sense that people got nervous. Retail is less so. So it'll remain to be seen that if we see a wave of retail bankruptcies, it would actually scare people and bring the market down. Yes.
You said that you're not worried about energy. What price of oil are you worried about?
Well, the reason I'm not worried about energy as much right now is companies kind of saw Jesus a little bit in what happened with oil going to the 20s, and that means that they cut their capex, and as prices came back and their stocks recovered and they got access to the market, they termed out all their near-term debt, they raised equity, and so at this point, pretty much, if you were going bankrupt, you went bankrupt, and if you made it, you've made it. Even if oil goes to 40, you're going to see spreads widen. It could scare people in the market. You could see a sell-up, but I don't see the wave of defaults that we saw in 14 and 15, because you just don't have the speculative companies that you had back then that are now out of business, and you don't have the good companies doing speculative things nearly as much. They have started to pick up capex. If you're in the Permian, you're definitely spending because it works in the 40s. But gas at $3 works really well in the Marcellus, but you can't get out of there, and it doesn't work that well in the other shales. So what all that ties together is, I think the biggest risk that you would actually have from oil prices staying low or going lower will be one of the areas that I'm going to talk about that I like, but that will need a higher oil prices, and that'll be some of the oil field service names and some of the rigs. But those companies, the reason I like them, have years of liquidity. Oil can go to 20; they're not going bankrupt for years. They've got contract coverage. They've got tons of borrowing, revolver capacity. Unlike the E&Ps, the E&Ps have a borrowing base that gets cut. So it's like right when you need the money the most, the banks come in and say you don't have it anymore, and that hastens the bankruptcies. And so people are learn that lesson as well, relying less on that. The oil service names don't necessarily have that problem. So let's talk a little bit about where we are seeing the total return opportunities. Again, the summary on high yield is it's not super exciting, it's not super sexy right now, but I don't see it as something that concerns me to where I just want to be out of the market. I do think there are things to do, and you just have to move outside the index to find them. So the first one we'll talk about is a company called Cinveo. This is just giving some examples of companies that we like. Cinveo makes envelopes. That's why people don't like it. It's similar to Harlan Clark, another company I like, which makes checks. All these are melting ice cubes, and the question is, how fast is the ice melting? And people have been waiting for the death of this and Harlan Clark for years, and the reality is these businesses actually are more stable than people expect, and they actually are more diversified. They have a label business that's actually growing, and they have a lot of costs they can take out. So while the top line might be coming down, they're gonna rip $50 million out of their cost structure over the next 18 months. And so, what happened with this name, and we'll see the yield on the next page, is this was actually trading pretty tight. It blew out when high yield blew out because they had a debt maturity coming due, and they were able to deal with that and push that out. But despite the fact that the business is actually heading back in the right direction now, you haven't seen this bond recover like you'd expect. And again, the things that we look for in companies is, this is a company that the perception is EBITDA is declining. It's not. It's going to go up, and in our view, and that's because of the fact that the top line is stable and they can take cost out, and it's not a very cash-intensive business. So we think this company can generate $100 million of free cash flow over the next 2 years. They're going to use that to buy back bonds, and so right now the leverage stats are still pretty high. Almost 7 times all in, but we think when you get to 18 and when this bond's going to need to be matured, the leverage stats are going to be very doable, especially through the secured leverage, which is where this is. We actually like the second liens here, which are in the 60s, which gets you more towards this leverage, given that dynamic, because we think the companies will use some of their free cash flow to buy those back. So. Again, there is still total return opportunity out there. This is a name that we think as people get more comfortable with this outlook and this forecast, you could make a 20% type return on. And again, I'm the top of the capital structure. So if I'm wrong, if the declines are double digits, something the company's still generating free cash flow, and I'm going to own the company. So these are the type of names that we're looking for, in kind of the riskier areas of high yield. And again, that was the chart I was showing where you've had that company missed their fourth quarter because of issues with the Staples Office Depot merger, and basically they'd already telegraphed it, but people, I guess, weren't paying attention and sold these down pretty dramatically. We think that this is going to get back towards where it was back before 2015. Another name we like that I mentioned earlier, and we like the sector in general, is the oil service. I mean, the deep water name specifically, and the reason we like them is you're really making just a long-term bet on whether we need to drill in the deep water again, and it's really that simple. The bears would say that given the economics in the Permian right now, and given the production elsewhere, you can the amount of deep water drilling we're going to need to do is going to go down dramatically. There's way too many rigs, etc. Our view is this is a cycle. It's going to come back. Oil demand continues to go up throughout the world, and the reality is that while there are areas in the U.S. that are more economic, deep water costs are coming down dramatically because of the fact that guys like this that were like rig that were leasing out their rigs for $500,000-$600,000 a day are now doing it for $200,000 a day. So that's bringing down the break-evens decisions. And the reality is, this is still where there are huge amounts of oil for the big, multinational type companies to find. So, they're less dependent on it having to be at 60 or at 70 because of that development. They're going to go ahead once they feel comfortable that oil's not going to go back down. So that's why, in your comment earlier, one of my biggest concerns on this is not that I need oil to go to 60 or 70 for this to work. I need it not to go back down to 40 or to be bouncing around, because if it could just stay at 50, the big companies are going to start to get, the big integrateds are going to start to get comfortable that the floor is in, and let's go ahead and restart some of these bigger developments. So the thing I'll point out on rig is, for a company that's yielding 9%, so over 300 basis points more than the high yield market, it has a $5 billion market cap. There's just not that many guys out there that have that. They can go issue equity tomorrow. They've already done that and paid off all their front end debt maturity. So there's nothing that's going to blow this up in the near term. They've got tons of liquidity. And the bonds we like, obviously, are longer dated bonds, so you get a lot of duration. So, it may 9% may not sound that exciting, but this was, as you can see at the coupon, this used to be a 6% type name. And if you look over on the left, when this is at 6%, these bonds were 115, 120. So, buying them today at 80, we think that these can, they get back to par, you're going to get a 25, 30% return. We think you can get even more than that if oil did run up to 70. So, and given that I'm buying at 80, and there's not that much secure debt in front of me, I'm going to get a pretty attractive, I've got pretty good downside protection. So again, it's a longer term bet that the deep waters needed. That's really what these are. But you're going to be paid pretty well for the size of this company. It's not just rig. I mean, rig is the biggest. It's Ensco, it's Rowan. Rowan's probably the highest quality. It's Noble. There's lots of names you can do this same specific trade on, and we think make 25% plus returns. Let's talk a little bit about distressed. People remember from Blazing Saddles, Slim Pickens is currently the thought we have for the opportunities in distressed. It's been you've had a pretty rapid cycle, and so there was a lot to do last year. Less so now. Like I said, most of the energy names are either they've either come out of bankruptcy or they're in the process. They're priced in. You'll be joining kind of the party late. You're going to end up owning reorged equity, so forth. But there are still some things to do. So again, we were talking earlier about the signs of the apocalypse that I was discussing. Default rates, we're still over 3.5%. They've come in under 3 now year to date as some of these bankruptcies roll off. But you go back and look at 2012, 13, you were 1. Prior to the financial crisis, we were 1. Even back in 97, 98, you were sub 2. Again, we don't think default rates are going to bottom for another year. You'll have to roll these all off, and so that's probably good for the high yield market in terms of us not putting a bottom in there. Not great though if you're looking to find opportunities in distress. But there are a couple things that we are doing. One of them is Puerto Rico. And Puerto Rico, I could come here and do a presentation for 2 hours tomorrow if you want on Puerto Rico, because we've been living this one for a while, and there are, as you can see, lots of different boxes you can go into and lots of debt. There are funds that are dedicated just to Puerto Rico. Those funds have not performed very well, is my guess, given what's happened and where the prices are, as you can see over there on the left. But there are ones that have done it. For people who don't know, Puerto Rico financed, as so many countries do, their budget deficits for years and years and years. They came up with novel ways to get around debt limits by setting up a sales tax structure called COFINA. Unfortunately, they can't print their own currency like we can, and so eventually they lost market access. After saying that they would never default, they of course defaulted. Congress then enacted the PROMESA, which was because Puerto Rico did not have access to Chapter 9 bankruptcy. It needed some mechanism to restructure its debts. And so Congress has put in this PROMESA, which effectively is a Chapter 9 for Puerto Rico. And it established an oversight board that is currently trying to foster everyone to get together and come up with a consensual deal. But if we don't get a deal done by May 1st is the deadline, then you will see the ability for this to end up in what's called Section 3 in the PROMESA, but which is effectively similar to a Chapter 9, except it'll be overseen, with the PROMESA we'll have which is a board that's been appointed by Congress. We'll have an outsized say in what ultimately happens, but you can get crammed down as part of that. That being said, we think the fact that one thing I've done a number of municipal restructurings. I did Jefferson County, did Detroit. One thing I learned is you don't want to be ahead of the game on municipal bankruptcies. You want to show up in about the 8th inning because they drag out much longer than you're expecting, and there's a lot of politics involved. And so the same has been true here on Puerto Rico. I mean, this has got the most politics you can imagine. But now that we've gotten to the point where this oversight board's in place, there are deadlines to get something done, we feel like that actually is going to help bring things to a conclusion. The oversight board's also going to force them, because it's not just a capital structure that needs to be taken care of here, it's their economics, and so they are going to force them to balance their budget and to really get their finances. They've approved a fiscal plan which will balance the budget now. So we think things are heading in the right direction right now in Puerto Rico, and we think that at least in terms of process, we have a new governor in place who seems to be more creditor friendly. In fact, his initial fiscal plan offered up more debt service than this oversight board ended up approving, which as a creditor we weren't that happy with, but at least his heart's in the right place. So the areas that we like, again, lots of different areas you can play. GOs are constitutionally protected. The Constitution said you have to pay GOs before anything else. Of course, that's not what's happened, but we still think that means that ultimately when you're handing out recoveries, and the oversight board said it, they're going to look at priorities and who has the priority. So buying GOs in the 50s right now, it's very hard for me to see how you're going to lose money. It's been more of a time value trade. Is it going to take another 3 years, and am I going to get 70? Not a great return. Again, because we think that that this deadline is coming up to get a deal done before you end up into an involuntary process, that something can be done sooner or later. And we think that that they actually have the ability to pay off the GOs using the cash flow from the other entities and to give them par. Probably won't happen at par because they're going to cut deals, but we see a lot of upside in that. Another name we don't like that trades at similar level is COFINA. Again, that's the sales tax. COFINA, the structure works. They collect sales tax. The first money goes to pay off these bonds, and the rest goes into the government coffers. The reason we don't like it is it's being challenged as the bond itself as being unconstitutional. And as hard as this is to believe in Detroit, that's what happened as well with a bond they issued, and for the same reason. They issued bonds through novel structures to get around debt limits. And in Detroit, the judge basically said he was going to invalidate the bonds, which means I lent you the money, but because you were borrowing the money illegally, the bond doesn't exist anymore, and I don't have to pay you back. That seems crazy, but that's what the precedent that's been set in Detroit is just because the government entity is doing something wrong, the fact that you're lending them, you're culpable as well, and hey, guess what? The money's gone. So you have no claim. So our worry on COFINA is that the GOs are challenging that COFINA structure, and maybe they win, maybe they lose. I don't want something where I could wake up and they could be at 20. So between those two, stick with the GOs. And then the Government Development Bank, big fan of buying anything at 21 where I'm pretty sure I'm going to get a recovery. That's kind of distressed investing 101 is if you can buy it at 20 and you're getting a recovery, it's probably going to be something that's pretty good. It gives you a lot of ability to cut deals. The Government Development Bank was one of the entities they used to fund these budget deficits. But it has real assets there. It has municipal loans you can borrow against. So we feel like in the 20s, we're going to be able to, and where Brigade is actually one of the people leading the process to try to work and cut a deal. Another thing I'll say on the Government Development Bank, is most of those bonds are owned on island by Puerto Ricans, and so screwing over the GDP, giving that a really low recovery creates another crisis. It bankrupts the co-ops that a lot of Puerto Ricans put their money into. So again, another nice thing to have is to be protected just by the people around you. So while the government, ultimately Puerto Rico may want to hurt New York bondholder, U.S. bondholders, but they're not going to want to hurt Puerto Rican bondholders. And so as long as we have the same claim, that's going to help. I'll go through these real quick. Just other distressed opportunities that we're seeing is in European energy service. So that's, as I said, the U.S. it's pretty much done, and the deep water rigs have plenty of time. The only area where I could see a bunch of restructurings in the near term is going to be in Europe, where a number of these companies still have not restructured and are starting to run out of time. We like all these names. Though Blue Water does FPSOs. One thing I'll say on all these, Blue Water, NC Trucks, NC Drill, when you're dealing with Europeans, they all have a really rich guy who runs it, who also has like 80 other businesses that you sometimes are hard to tell whether, which business is which. And so, that is one of the bigger risks here, is having to deal with that dynamic. It's a dynamic you don't tend to have to deal with in the United States. That creates an overhang, but Blue Water is one where these FPSOs you need these for specific wells that you're drilling or production you're drilling, and once they're there, it's very expensive to change. And so as drilling picks back up, these guys are sitting on a bunch that can be retooled, and we think as they do that, it's going to allow them to deal with their 2019 notes. Sea Trucks. Those are in the 30s. It's one of the few names that hasn't rallied back. Again, it's got it basically does subsea installation. A lot of their business is in Nigeria. Their owner is not Nigerian, but he lives in Nigeria. He has all the connections. He's fighting now with the company. We've had to replace the board. And so that's creating the overhang is, again, what's this guy, what negative things is he going to do? Ultimately, again, in the 30s, we think that there's an economic solution that works for both people. Seadrill is a bit big, another similar to rig. The thing we like about Seadrill, again, they've got contract coverage through 2019, so they're going to be free cash flow positive for the next 4 years. And on both Sea Trucks and Seadrill, you're creating the fleet at huge discounts to replacement value. So we don't need it to get back anywhere close to where it was in 14. We need it just to come back, and there's upside. Last thing I'll talk about is private credit. This is an increasing area within the credit universe in terms of money being deployed and companies seeking it out. And one of the things I'll talk about is why that exists. What you've seen obviously with Dodd-Frank is the regulatory environment changed. Banks have gotten, you're certainly seeing less liquidity in the high yield market. They have not wanted to lend to the range of companies they used to, and so that's created the opportunity for investors to go direct to companies, either through private credit funds that they set up, or firms like ourselves. We go to companies that we're familiar with solutions where we can really structure deals and take down all or a large chunk of that deal, and we'll get into a few examples of that. And again, the reason why a company is going to seek out, private credit, are listed there below. It's a lot of them now too small. The banks want larger deals. Also you're going to see unfamiliar, unpopular businesses. We'll get into one of those. We talked about some earlier that are in the markets, but there are companies out there that the high yield market and people have had bad experiences with. But if you're comfortable with them, you can go direct and do something. And then obviously project finance type deals. So here's one example of something Brigade did, which was with Toys R Us, which again, under pressure retailer, had debt maturities coming due, losing access to the capital markets. We were able to go to the company and structure and help them get a CMBS deal done. They had the front, the top, the mortgage loan lined up, but they weren't able to get the full amount of debt done here to get this deal. And so what we ended up doing is setting up a structure that pays down. It's basically a 3-year amortizing structure. So from their point of view, and we took the entire thing down, and so they were able to get a financing done at a time where they were shut out of the capital markets. And for Brigade, we're not taking a long-term bet on Toys R Us. We're taking a 3-year bet, and it's a bet that pays down by roughly a third every year. So it's basically allowed the company to start focusing on trying to turn their business around. I will say that has not happened thus far, but we don't because of this, we don't think a bankruptcy is imminent. Yes.
How much are you able to sidestep the investment banking process or the auction process for some of these loans? Because you said you went directly to
We did.
Toys R Us?
Yes. The reason we went directly to them is we owned significant debt throughout their capital structure away from this, so we had a very good relationship with them, and we were familiar with the fact that that they owned a good portfolio of properties that we thought were stores that even if they did have to file for bankruptcy or slash stores, close stores, these were not the money losers. These were ones that they were going to want to keep. So it's because we have that prior relationship. We're not in the private lending business per se. We don't have a fund where we go out and we try to seek it out. We tend to do it through situations that we're already familiar with and that need a solution. And go to the company, and again, it allows us to structure something where in the case of this, you're getting pretty attractive total returns for something. This is double-digit type returns for something that's going to amortize over 3 years.
Is that starting to change that private lending mentality, or not being auction deal, or?
Well, again, you have seen that. He says that's starting to change, meaning less auction deal. I mean, big companies are still going to go through the investment bank. Where it's changing is like I said, there's the bank. Some of the larger banks are less comfortable with some of the companies on the periphery. So where it's changing is companies that in terms of new deals that the market's not familiar with, don't have a lot of scale. They don't see a long-term big investment banking relationship with, et cetera. So that's where it's starting on the new deal. This is an example of Toys R Us, at a time where they were very distressed, needing a creative way to and so rather than going to the high yield market and having to do something that was very expensive, or at all, they were able to come to us and get this done.
Quick question: so they actually own those stores, or
Yes.
some companies own
Yes.
them? Actually own them?
Yeah. Last one I'll talk about is Mount Airy Casinos. This falls in the project finance category. This was actually a project finance deal that JP Morgan had done and had been unable to syndicate, because of the financial crisis and because the property came out below expectations initially. We felt we've done a number of casino financings, and so this is an area of expertise for our firm. And when we looked at this casino, it just didn't have a lot of competition risk in the near term, and we felt that it was just underperforming what it could do. There was issues with management and things such as that. So we looked in, did our due diligence on this, and were able to go to JP Morgan and structure a loan ourselves to take out their syndication, which we thought was a very attractive 13% coupon. It came at a discount. It had super tight covenants. They had to use all their free cash flow to delever, and so again, it's you're able to create your own destiny in some of these. Obviously, if the company hadn't performed, it wouldn't have been. If our due diligence is wrong, it wouldn't have been as good. But because you can structure it yourself, you help limit your downside. In the case where it doesn't work. So. With that kind of ends the presentation. So I guess the summary, is again, to show that while high yield has gotten tight, while we've had a pretty strong rally for the last 12 months. I think if you are creative, you kind of look outside the box, you go direct to companies, look at some of these more one-off distressed opportunities, there are still total return opportunities out there. And so with that, if there are any other questions? Yes?
I'm just going to ask about the change in tax rates that would do on your high-end companies with cost-effective interest.
Right. I think initially it would probably be a good thing because you'd have less supply, so companies wouldn't want to issue as much debt. And anytime you have low supply, it tends to money that's being recycled doesn't have anywhere to go, and it tends to cause spreads to tighten in on what's still out there. Long term, it would be bad. Because it would dry the market up, it would hurt liquidity. As issuance went down, you could see people run from the asset class and so forth. So not something I'm rooting for, even though the initial benefit might be positive to high yield spreads.
Okay, just on the individual companies will struggle to pay interest and tax bills. They just have to be in a kind of sweet spot where
Well, again, if it's something that's not done. If something's done retroactively, it's not something done prospectively, I think that would be pretty devastating for a number of companies. My guess would be it would be something going forward, but who knows? So that would be a big variable in terms of what if it's simply going forward. I think the comments I had apply.
I think one of the other things you mentioned was liquidity driving some of the forward returns over a couple of years. Can you see any kind of structural change in liquidity back where it used to be, or what would you kind of move what happened in the market to trade more high yield?
I don't outside the index. There's still lots of liquidity in the index and in index names, but I think that's going to be something you're going to have to deal with. It's a negative for when you wake up and you look at your P&L and you're down 10% because the market's down that much. So it's because it's going to increase volatility. It's a positive, though, if you're someone who has dedicated capital and can take advantage of it. So on a name like Synveo, we were able to buy some of those senior bonds when they fell in an air pocket from the 80s to into the 60s and we're talking like on a few million, and then that got people panicking, and then you were able to actually buy them there, even though it wasn't like they worked their way down. There was just no bid, and so that created the opportunity to actually buy those. I do think that it's something that you're going to have to live with. That it's increased volatility. One thing I'll say, don't be fooled. It seems like a lot of the private credit funds out there, the attraction is that this perception that I don't have this volatility. I don't have to wake up and see them down 10%. Well, every private credit fund was down 20%, whether they know it or not. They probably didn't report it, but if you'd had to go sell those loans, certainly, credit quality at the end of 2015 didn't really matter as much in terms of, quality names were still down in the high yield market. And so what private credit does is it gives you comfort that you're just betting on the individual names, and you don't have to watch the mark to market. But ultimately, if you needed that money then, it was down 20% at the same time. Any other questions? All right, great. Well, thanks a lot. Appreciate it.